Perhaps we can start. I'm very pleased to have our speaker from the IMF, who will be making presentation on the latest way of looking out, chapter 4, on the trading places real spillovers from G20 emerging markets. I think this has also very, very interesting links to our GBC and with linkages in Asia Pacific. So I look forward to insights and perspective today. So let me briefly introduce our speaker today. So the name is Nicolas Frandes Arias, and he's an economist in the multilateral surveillance division of the department. His research includes macroeconomics, economic growth, and innovation, and involves a combination of empirical analysis, quantitative structural modeling, external economic data, and analyze policy controls. MA, BA, MA, and PhD all from economics. The BA should be on the study, mathematics. Essentially, the MA and PhD in economics all from principle. So we are going to listen to around the 30 minutes of presentation by Nicholas, to be followed by 10 minutes by my colleague Neil for the discussion. And during the presentation, if any audience has any questions about technical issues, then you are free to raise those questions. But otherwise, we will allocate more time to have more engaged in later. Okay, so over to you.
Thank you, and thank you very much for the invitation. I'm very happy to be presenting this work here. I think it's hard to think of a better place to present this particular piece of work, as you mentioned. Before I start, let me just say that this is a joint project with a large team of colleagues who are listed on this slide. So let me begin by motivating a little bit the subjects that we study in this chapter. Chapter 4 of the World Economic Outlook is aimed at studying spillovers, and here we're studying real spillovers from large emerging markets, so emerging markets in the 20 countries, specifically through trade and global value chains. So why have we chosen to study this now? First, this group of countries has consistently outgrown advanced economies over the past several decades, to the point where now the G20 emerging markets make up about 1/3 of global output, and have significantly integrated more in trade and global value chains. At the same time, there is appears to be a slowdown in growth prospects globally, with this group of countries contributing to that. We can see that on the left chart on this slide, which shows the slowdown driven by advanced economies, but also with contributions from China, important contributions from China and other G20 emerging markets. And in terms of evidence of increasing sort of connections with the global economy, on the right, we show the correlation of idiosyncratic growth surprises in G20 emerging markets with advanced economies in two time periods. In blue, from 1990 to 2013, where the correlation is relatively weak, and in red, in the last 10 years, where the correlation is stronger. And so the question for us is, does this increasing integration and potentially slowing growth prospects portend negative spillovers to the rest of the world, or what kind of spillovers might this have to the global economy? So to further document this increasing integration via trade, we have a few different measures here on this slide. On the left, we show the results of a standard gravity equation estimation, where what we're showing here is the estimate of a shifter for all pairs involving G20 emerging markets. So what it says is that trade involving G20 emerging markets has increased by about 60% more than other bilateral trade linkages since 2000. So this points to the disproportionate increase in integration of these economies in the last 2 decades.
So just to clarify, that's just between the G20 EM, or this G20 EM with everybody else?
With everybody else. So if the pair includes the G20 EM, it is included, in the shifter down is equal to 1. Now, in the middle, we show kind of a more sort of just a more sort of, let's say, direct measure, not through a gravity model estimation, but just the share of global exports and imports that involves a G20 emerging market. And similarly, it shows a large increase since around 2000, with exports, more than doubling and imports close to doubling as a share of all exports and imports, respectively. We also see this increasing integration not just in trade, but also in direct investment, shown on the right-hand side chart, which increases from about 6 to 10% of total FDI. And this is outwardly forecast by G20 emerging markets. So we also, just to kind of give a complete picture of the increasing integration of the economies in the global economy, we look at also financial linkages here. But previously, we looked at foreign direct investment. Here we look at more short-term flows, like cross-border bank lending on the left side, which here we plot as a percentage of G5 GDP. So this is lending to G20 markets, G20 emerging markets from G5 economies, and it has increased from about 1% of GDP in 2000 to about 2% in 2022, driven by increases in Brazil, China, India, and Mexico. We can turn this around in the middle chart, where we look at bank lending from G20 emerging market banks to other groups of economies as a percentage of all reported bank claims on the respective group. And there's really two stories that come out of this analysis. One, that lending from G20 emerging market banks to each other and to advanced economies is relatively limited as a percentage of bank claims on those groups. It hasn't really changed much in the last 7 years, let's say, what's shown in this chart since 2015. But lending to non-G20 emerging markets and developing economies is much larger as a percentage of lending to those economies, and has grown significantly from about 13% in 2015 to 20% or so in the latest observation, 2023. And this sort of is consistent with other evidence that is documented about the rise of Chinese banks and just more generally increasing south-to-south financial flows. We also look at portfolio assets and liabilities in the right chart. So FDI and bank lending here, portfolio assets and liabilities, and similar pattern emerges. The left panel shows G20 emerging market portfolio liabilities to G5 countries as a percent of their portfolio assets, and it has nearly doubled from about 3% to 5%, with a very important contribution from China and India. See here. And then in the other direction, G20 emerging market portfolio assets as a percentage of total global portfolio assets has also increased, though to a lesser extent. So
here, not only China, but Saudi Arabia. Is it Saudi Arabia on the right-hand side?
Saudi Arabia is very important, yes, on the right-hand side. Yes, it's the main one here. Although in this case, it shows, it doesn't show much of an increase as to China does, although the increase is less dramatic than the other.
On the very left-hand side chart, is this based on location or consolidated banking statistics? I'm asking because if you look at China, for example, that much of the ever outflows will go through, say, Hong Kong, and then probably you would only see it's really consolidated.
Yeah, so there's to some extent that I'll have to check exactly to answer your question in detail, but there is to some extent an underestimate in these figures because they don't fully account for flows through other jurisdictions. Yeah.
Sorry.
Yes.
One more question. To put things into perspective, what is the share of Asia Pacific within the G20 GDP? Just because you start with investment trade, which is share of Asia Pacific G20 in terms of GDP. Yeah, I know that China, India, Indonesia. Just to
I mean, if certainly in this group of economies, G20 emerging markets, it would be a very important share. China and India. I don't have the number off the top of my head, but certainly like 50%, in terms of. But I can look. Okay.
Great. Question was share EM Asia in.
Yeah, in the of G20, so then we have an idea of what to do.
So G20 including the event?
Yeah.
Maybe a little bit.
Yeah.
Smaller. Yeah.
I think yes, PPP, market trade rate.
So
Yeah, China,
India,
India,
Brazil, that's big. I mean,
non-Asian emerging market should be Russia, Brazil.
There's a list on the left chart, so it's like 10 of the G20, is that right?
Yes, half of the G20. And it would, I mean, it would be something, China is about 20% of global.
Yeah.
It's gonna be at least 20. And it's gonna be probably not much more than that because the economies are gonna make up most, G20 is gonna make up most of the residual. So something about.
Yeah. I don't
So let me take a quick sort of sidestep to discuss one of the boxes we do, which looks at the allocation puzzle. So this allocation puzzle is something that has been documented in the literature on international capital flows that sort of basically is the fact that there doesn't seem to be a strong correlation between net capital flows and growth in per capita output. And this is a puzzle, of course, because we think based on kind of the neoclassical model that capital flow should boost output by shifting capital to places with higher returns to investment. In the left panel, we replicate this result in a large group of economies using data from 1980 to 2019. And we find indeed that there really is no correlation between these two variables when looking at all the groups, all the countries in the sample, and also when looking at G20 emerging markets specifically. However, on the right-hand side, we show that we look at it only looking at private net capital flows, and then we do find a positive correlation. Again, both when considering the whole sample and when considering G20 emerging markets. So economies that receive more net capital, private net capital inflows, grow faster in terms of per capita output. So this, this basically, shows that the allocation puzzle is due to public flows, which in turn reflects sort of reserve accumulation by fast growing G20 emerging markets. Meanwhile, private capital flows are associated with faster growth, which points to increasing financial integration being beneficial to growth in these economies. So I've been talking a little, about financial flows in the last couple of slides, and so these are important, of course, and worth looking into in future work. But because of their relatively smaller scale compared to the increasing trade and global value chain linkages, in this chapter we're going to focus on those. So let me continue sort of documenting those in a little bit more detail. On the left side of the slide, we look at the share of production in different commodities accounted for by G20 emerging markets. Top three bars decompose commodity production into its three components, and for each one of these, G20 emerging markets produce around or more than 50% of global production. China is, of course, importantly well represented here, but every one of the economies is visible. In particular, Brazil and India make a large contribution for agricultural output, and Russia has large contributions for energy output. Going further, when we consider commodities that will be important in the green transition, there's several cases where G20 emerging markets also play an important role. So, China is of course visible when you look at coal, lithium, copper, nickel, but also Argentina for lithium and Indonesia, of course, for nickel is an extremely important producer. So as demand for these economies increases going forward during the green transition, it's natural to think that even more integration with economy chains will take place. G20 emerging markets. In the middle chart, we look at increasing. So we instead of looking at trade generally, we focus on global value chain linkages. So we look at we take the share of inputs to production. That's input linkages, where the share of demand for outputs, including intermediate outputs, by other economies relative to G20 emerging markets, and look at the median across other economies in the world. We find that both of these have about doubled since 2000. Okay, so the median economy has increased its connection, global value chains with G20 emerging markets. And on the right, we break this out into the components, the sector level, and we see particularly important role of G20 emerging markets as sources of demand for mining and metals output, and manufactured outputs, as well as source of manufactured inputs into production processes elsewhere. And we can see, really all of the G20 emerging markets represented in this right panel. So this is, while China is of course a dominant player here, and we'll see more results that point in that direction later, this is really a story about all of the G20 emerging markets. So finally, here we look at how, as G20 emerging markets have grown, integrated into the global economy, diversified their economies and improved their macro policy frameworks, their output fluctuations have become more similar to those of advanced economies. So on the left, we look at annual output volatility, G20 emerging markets from 1980 to looking at the next 10 years from the date shown here, so over the last 40 years, we see that it has declined as that of advanced economies has increased to the point where they're no longer distinguishable from each other. And on the right panel, we look at the contribution to quarterly output volatility in G20 emerging markets from domestic and foreign shocks in blue and red respectively. And we see that since 2003, the relative contribution of domestic shocks has increased, as this volatility has also declined. See on the chart, which again is a feature that has typically been associated with advanced economies. And so the question for us is, to what extent can these domestic shocks, which are now driving most output fluctuations in G20 emerging markets, propagate or spill over to other economies? So in order to assess this question, we essentially take 4 different approaches, which come in 2 groups. The first 2 are empirical and are based on historical data from the last 20 or so years, and in some cases split the sample to look at the changes in the results depending on the beginning of the sample or the end of the sample. The first one is going to be a set of vector autoregression models, structural VARs, and global VARs that are going to look at how aggregate demand and aggregate supply shocks spill over and explain GDP fluctuations in other economies. The second one is going to be kind of a sensitivity regression analysis, where we look at firm level data and assess the particular exposure of the firm's sector to G20 emerging markets. So whether it's input or output linkages, essentially going back to the previous chart I showed, and see how revenue growth responds to growth surprises in G20 emerging markets, depending on the type of exposure. And then the last 2 are going to be model simulations that are more forward-looking. So Thermo is going to use a trade model, which is going to be calibrated to represent kind of a medium to long-term analysis, like in comparison of steady states, let's say, and see what the aggregate and global economy, regional impact, and also sectoral reallocation impacts of productivity shocks in G20 emerging markets at a sectoral level. And then finally, we'll take a kind of forward-looking analysis in the long term to see to what extent a plausible sort of upside scenario in G20 emerging markets other than China can compensate for a potential slowdown in China. So how much can other G20 emerging markets support global growth if we consider kind of what might be a plausible upside scenario? Okay, so diving in here, this is starting with the vector autoregression analysis. On the left, we see the results of the structural VAR analysis, looking at the fraction of output variance that can be explained by shocks from G20 emerging markets. There's really one bar that stands out, which is the rule of shocks from China, both aggregate demand and aggregate supply shocks, that explain output fluctuation in other emerging markets. So this is about the amount, the fraction of output fluctuations that can be explained by the United States in our specification. So it really shows that China has become as important as the United States in explaining output fluctuations in other G20 emerging markets. In terms of explaining advanced economies' output fluctuations, it explains a smaller share, around a little bit more than 4%. And we see also that other G20 emerging markets, are less able to explain sort of output fluctuations at the global level. However, if we look at the right chart, which breaks out the role in sort of the impact of aggregate demand and aggregate supply shocks of different G20 emerging markets at the regional level, we see that while China is important for every region, other G20 emerging markets play an important role at the regional level. So for example, Brazil and Mexico play an important role in the Americas in the third panel. And Russia and Turkey play an important role in Europe and in Central Asia. So this is kind of a theme that will come out of many of our results, that China is important globally and other G20 emerging markets tend to be more important at a regional level. So sort of focusing a little bit more on this kind of regional implications as well as the global importance of China. The third box that we study looks specifically at the role of G20 emerging markets in sub-Saharan Africa. So we look at the import and export share, FDI linkages, and then we do a sort of empirical analysis of spillovers, as we did before, look at how the effect is different depending on the type of economy in the region. So on the left, quickly, we see from 2000 to 2022, the import and export share of sub-Saharan African countries associated with G20 emerging markets, in particular China, has increased significantly to the point where now 35% of imports of G20 emerging markets, 40% of exports. In the middle, we look at foreign direct investment and see again a really important role in terms of the number of FDI projects from China and India, as well as from South Africa in countries other than South Africa on the left. With other G20 emerging markets also playing a role, particularly in South Africa, but less than these two or three economies, depending on which one we're considering. And finally, on the right, we look at the impact of a negative shock in China, other G20 emerging markets, and South Africa on three different groups of economies in sub-Saharan Africa: oil exporters, other resource-intensive countries, and non-resource-intensive countries. And you see that China has a very large impact on oil exporters from a negative shock. So this is kind of one of the takeaways of this analysis, that while increasing integration of China with sub-Saharan Africa has supported higher growth in these regions, that has the potential to boost their economic outcomes. It also exposes them to risks from the declining demand, in particular to oil exporters. Another thing to highlight is that South Africa has a much smaller impact on oil exporters, but has a somewhat higher impact on other resource-intensive economies in red. And then not shown here, if we consider specifically the impact of South Africa, of a negative 1 percentage point shock in South Africa on economies in this Southern African Customs Union, it's similar to the impact of China on sub-Saharan African countries in general. So this again speaks to the sort of regional importance of G20 emerging markets other than China.
Just a quick question on the middle chart, Nicola. I'm surprised. I didn't know that India was actually an important source of FDI for sub-Saharan Africa, sub-Saharan African countries. Any clue what is it driven by a particular sector, or because in some cases it's bigger than China's FDI to Africa?
Yeah, that's true. I'll have to get back to you on specific sectors that it's behind, but it's true that again, it's really not just China. It's true we see in Nigeria and in Kenya that it plays a more important role than China, as well as a few others. Thanks. Here we return to the main vector autoregression analysis, and we just look at splitting the two samples, splitting the sample in 2000 and 2019 into two components, and really look at the fraction of output variance that can be explained by shocks from to G20 emerging markets. Here we're excluding the United States as a recipient and China as a source of shocks. And we see that even when doing so, there has been, in several countries, an increasing role of G20 emerging markets explaining shocks. So the way to read it is essentially that points below the 45-degree line see larger share of their output variance explained by G20 emerging markets, the G20 advanced economies, and the left panel look at the first 10 years of the sample. So there's more squares below the 45-degree line, the right panel, showing that there's more obviously see a larger role for G20 emerging markets than G20 fixed economies. So turning to the next empirical analysis that we do here with firm level data and looking at how the sector of the firm affects the its sensitivity to growth fluctuations in G20 emerging markets. On the left, we find that firms that depend on G20 emerging markets for demand see an important boost to revenues from associated with positive growth surprise in G20 emerging markets. So 1 percentage point higher growth in G20 emerging markets leads to 0.5 percentage point higher revenue in these firms, and this continues for the medium term. It declines to about half of the boost to growth in the medium term, which is still quite large. So this is quite a boost to these export-dependent firms. But at the same time, import-dependent firms in red don't see this boost, and we can see that in terms of the sensitivity to many of these economies in G20 EMs on the right, that several see a decline effect. And so the way we interpret this is that a positive growth surprise in G20 emerging markets could represent increased productivity, which would imply cheaper inputs and some more competitiveness for firms that depend on them for inputs. At the same time, it could represent increased competition as firms in G20 emerging markets enter into new products that compete with the firms that they previously supplied. So this is kind of the net of two effects, and in some cases the second dominates, like particularly in a longer horizon, like China and Mexico, for example. Turkey is the opposite. So turning to the analysis with the quantitative trade model, again, we sort of on the left panel we show the results of two of the scenarios that we run. The leftmost bar looks at a scenario in which we take 2018 input-output data and shock every sector in all G20 emerging markets with negative 2.5% TFP shock. This amounts to a little bit less than a 10% decline in output in each of the G20 emerging markets. And here we look at the impact on global GDP, excluding G20 emerging markets. So the decline is by 0.15%. This is a little bit smaller than the results we found before in the empirical analysis. In part, this reflects the fact that this is kind of a comparison to steady states. It doesn't account for investment changes, but also it's really just looking at one channel, which is trade. However, there's a few things that we do with this approach that kind of speak to the large and growing integration of G20 emerging markets in input-output linkages globally. First, we can compare simply to the results of running the same experiment focused on the United States. So applying the same negative total factor productivity shocks to the United States, and that's indicated by the white diamond on the left bar, which shows it's less of an impact on the global economy than even just China, let alone all G20 emerging markets together. And second, we can run the same scenario using as a starting point the data from 2000, and we see that the impact was about 1/3 as large. And actually, since then, the United States has declined in importance, while G20 emerging markets have increased in importance for the global economy. The third bar of the panel shows the results of a scenario where we shock only, in the same way, only sectors in G20 emerging markets that are particularly integrated into global value chains. And we see, in that case, the impact on output of, domestically in G20 emerging markets is about a little bit more than 1/3 of what it was in the first scenario, but the impact on global output is a little bit less than 2/3. So this speaks to this particular importance of these sectors' shocks for spillovers through global value chain channels. And in particular, we compare again to the United States, which is even smaller by comparison in this scenario. So on the right panel, we look at the regional dimension, and again, we see this kind of narrative. Again, it's the baseline shock. We show all the sectors, similar narrative as we've found in the empirical analysis, where China is important, it has large spillovers to every region, and other G20 emerging markets are particularly important in their own region or specific regions. So Asian economies are some of the more hard hit than European and Western Hemisphere economies due to the large linkages with China. The rest of the world group, which includes most developing economies, is also particularly hard hit in this scenario, with India playing a more important role than other regions. And then again, we see the importance of Russia in Europe and Middle East and Central Asia, as well as the importance of Mexico in Western Hemisphere, which is particularly driven by Central and North American. So with this analysis, we can now look at the impact at the sectoral level in the shock, in the scenario, the second scenario, the one that I mentioned, using 2018 as a starting point and looking at the impact on global value chains. Looking at a scenario where we reduce productivity in both value chain sectors. And we see that, underlying the aggregate impact, so the aggregate impact on global value added outside of G20 emerging markets was about minus 0.1. We see that the fluctuations at the sectoral level are large compared to that aggregate impact and quite heterogeneous. So, commodities, particularly agriculture and fishing commodities, contract, as well as food production, and this one kind of manufacturing sector, and everything to the right of utilities and construction. So that and trade and transportation, as well as services, tend to contract. Meanwhile, manufacturing sectors, other than the ones I just mentioned, tend to contract by less or even expand, and in some cases quite significantly. So for example, textiles expand significantly, as well as metals, electronics, computers, and electrical equipment, which are the four on the right. So electrical equipment is the last one, the one that expands by the most, other than textiles. And these heterogeneous responses follow the price signal. So the black diamonds indicate the relative, sort of the median change in the price relative to the country's aggregate wage in the model in response to these shocks.
Sorry, Nicola, just explain to me, what's the scenario?
Scenarios where we apply a negative 2.5% total factor productivity shock to every to sectors in G20 emerging markets that are particularly integrated into global value chain. So this is a lot of manufacturing sectors, but also energy related sectors and trading related sectors. So it's transportation related sector. So there's a list in the guys, but you can think of it as roughly manufacturing and certain commodities.
Then why many of the advanced economies, particularly the metals and electric benefit from this kind of benefit?
Well, so yeah, I mean it would be every economy is hurt in this scenario. So value added declines, real wage declines, and so on. But certain sectors expand because of the fact that the decline in output from G20 emerging markets means that the price, the relative price of that sector's output increases in their own economy, both for domestic use and for export, and so reallocates labor to the production in that sector. That's why it's kind of, you can look at the correlation between the bars and the dots, and that's really just the impact on value added and impact on the price. So in general, there's kind of like a downward bias in the sense that you see a decline even for in places where the real price doesn't change, and then you really see expansions where the price increases. And the other kind of interesting takeaway from this analysis is that the contribution of different income groups to the changes in sectoral value added depends on the sector in a sort of intuitive way. So commodities, the decline in commodities production and the increase in textiles, these are relatively larger contributions from developing economies. Whereas the expansion in metals and computers, electronics, and electrical equipment sees a relatively larger contribution. So this speaks to different roles that different income groups play in the global economy, and therefore the nature of their sensitivities to shocks from G20 markets. We do a couple more scenarios in the chapter. One of them is kind of this sort of case study scenario where instead of shocking all G20 emerging markets, we shock only one sector. China. We shock the construction sector in China. So we reduce productivity in China construction sector by 2.5%, as we did in the other examples. And so this implies roughly a domestic impact on the construction sector of about -6% value added in China. Other sectors by about 0.5% in sort of downstream linkages in China. And aggregate output declines in China by about 1%. So it is about 10 as large as the other sectors, but we see very important impact on the volume as it being relative to that domestic impact, and we're normalizing the impact of the shock. And in particular, we see declines in sort of energy, mining commodities, mining support services, and coke and refined petroleum products, as well as water and air transport, which sort of speaks to upstream linkages in terms of reduced demand for inputs to the Chinese construction sector scenario. And again, a large contribution from developing economies and emerging market economies. Just to say, one of the reasons why the red is a lot more prominent here, other emerging markets, is that here we're now looking at also the impact on other G20 emerging markets. The previous one outside of G20 emerging markets.
Right, and so just the axes are different here.
Yeah.
Maybe just looking at the left axis.
Left axis is for the bars. The right axis is for the price.
Okay, and so if one goes by the left axis, one of the messages is actually the spillovers are actually not that large in magnitude.
Yeah.
They're same.
Yes.
So in other words, it's like 0.. Yeah.
Yes. I mean, so if we want to compare to the previous one, it's like it's about a tenth. Now, here we were shocking all the G20 emerging markets and looking at the impact on the rest of the world. Here we're only shocking China and looking at the impact on the rest of the world, including other G20 emerging markets. And again, I think one of the reasons that we see sort of a relatively muted response is the calibration of the model is really meant to capture kind of like an alternative steady state rather than sort of a short-term impact. It doesn't account for a decline, for example, in investment in response. And it sort of doesn't, it allows countries to substitute for the
It also reflects, because the reason I asked this, we did similar analysis in last year's Asian Development Outlook. And basically, we do find of a slowdown in China's property sector, and we find very similar things there. Big effects on China, not so much spillovers, primarily because the upstream linkages are mostly domestic, except for coal. So Mongolia is basically the country that gets affected the most. But that's sort of consistent with what you have here. Sort of yes, negative spillovers, not really that big in magnitude. And again, it's mostly reflecting the nature of the linkages of China's construction sector. How much is domestic, how much is international.
Yeah, I don't know. It's good for you to know. And so, the upstream linkages are kind of coming through here in the same sectors that you mentioned. And then also we find we think it's interesting, just a little bit of the same flavor of the previous scenario where manufacturing tends to kind of, do a little bit better. And, our interpretation of this is that, this represents kind of, you have these negative downstream as well for the construction sector slowdown. And these can propagate in the same way as in the previous scenarios where we directly shock the sectors. Output in each of these sectors declines by about 0.5%, which is, roughly speaking, is a little bit less than a tenth of what we saw in the previous scenario, the G20 scenario, and similarly, you see an increase in textiles.
Textiles so stands out in both cases.
Yes.
Why is that? Why is it?
Yeah, I mean, it's worth kind of diving in more and trying to really understand why. I mean, I think, it represents the important role, of China producing textiles, so that the declining output from China has a large impact on the price, and so reallocates a lot of production to other economies, or has a large impact on their textiles industries. But there's certainly more to look into to try to understand kind of what is it about how we sort of predict how sectors will respond in these spaces, and we can measure development, for example, to really understand that. But our interpretation is that this reflects these downstream spillovers from the Chinese construction sector to other sectors of China, which then propagates similarly to the previous.
I may want to say something about China maybe, or Also, construction sector is probably not the best example here, but if you were to apply a shock just in China across all the sectors, have you considered splitting foreign versus domestic companies? So I'm asking because the productivity shock, to the extent it's exogenous, could be a standard, for example, for geo-economic fragmentation. We are reading a lot about foreign companies relocating out of China. So to that extent, it's explained to
Yeah, I mean, so that would be a very interesting scenario. I think it's not something that one can sort of automatically do here because the input-output data doesn't kind of distinguish at the firm level. You know, in principle, I think one could try to sort of attribute sectoral output to foreign versus domestic firms by looking at characteristics of foreign and domestic firms and what kinds of sectors they specialize in. And you know, hopefully that would tell you something. I mean, I think you could turn that into that kind of question. I think it's very interesting to look at. You know, one thing that is a challenge here is that even though we have 45 sectors, that's still a pretty rough decomposition of the economy. So when you saw that in the firm level analysis, sort of there we had 26 sectors, a little bit less, but roughly the same order of magnitude. And there was a large scope of this kind of within sector competition in terms of or let me just say that inputs to other sectors becoming competition, which suggests, you know, there's a lot of different things happening at the sector level. So that could be a challenge, that scenario, if, you know, the differences between foreign and domestic firms are really within the sector at this level of aggregation. But yeah, I think that would be a very interesting thing to look at. And, you know, again, it would sort of amount to kind of translating that into which sectors you shock.
Can I also have one more question? So I think this scenario, the shock is coming from productivity, right? Particularly in Chinese shopping sector. So I'm just wondering if we differentiate the type of shocks, like maybe final demand shock. Yeah, for the construction, maybe for the housing. So would it be very different?
This, I mean, this is it's something that we can check. I don't think it would be very different to the extent that you know, the most of the output of this sector is domestic. There's some sense in which there's like an isomorphism between productivity. You know, it's kind of like you can sort of think of it as a taste shock. Instead of producing less, that go, you know, what goes into the utility function of reagents in China would just be less. Similarly, they can do something like that with intermediate production. I think maybe one important distinction would be there might be an asymmetry introduced in terms of the construction that's for final demand and the construction that's being put into other sectors. Because you might imagine that if you want to change final demand, you only change one of them, not its role in production, for example. Here it's kind of more as though we're changing its role in production and its role in final demand. So that, I suppose, it's something that we can look at. I guess I would expect maybe that you would see more, you know, you would see more of the kind of upstream linkages and maybe less of the downstream linkages, so less of the impact on textiles and like more on the commodities or transportation. But this is something that, you know, we'll check. There has been other work that does something along those lines that I can point you to. A previous publication that looks at, you know, taste shock in Chinese construction.
You can kind of wrap up.
Yeah, yes. So, you know, very quickly, this is the fourth sort of model simulation that we do, where kind of we essentially look at a scenario for other G20 emerging markets that has about a 30% chance higher growth than the baseline. By more than this, it's 30% likely based on the historical growth experience of these economies. Scenario, global output goes up by 0.5%. Growth increases by 0.5% in the global economy, with about 15% of this being caused by spillovers, 89% of the other G20. China. You see positive spillovers to China and advanced economies, as well as to each other in the fourth. We also look at the impact of the rise of subsidies, both advanced economies and emerging markets in the left panel, and look at the impact of the intensive and extensive margin on export amounts and probability of exports, and indeed find that subsidies have dramatically increased over the last 10 to 15 years, and that subsidies do increase the exports of a good and the probability of being exported. So that's box one. And let me just move forward in the interest of time and conclude. So our overall takeaways are that growth spillovers from domestic shocks in G20 emerging markets have increased in the last 2 decades and are comparable to those from advanced economies. These spillovers entail heterogeneous response at the sectoral level and induce important reallocation, economic activity and jobs across sectors. And that while a slowdown in China would be very costly for the global economy, a plausible growth acceleration in emerging markets could generate positive global spillovers to boost world growth. Policy messages that come from our analysis are that structural reforms, particularly in labor markets and in business regulation, can help sectors able to adjust in terms of the sectoral reallocation that occurs in response to growth in G20 emerging markets. But of course, because there's potentially harmful negative harmful distributional impact of these spillovers, inclusive policies like targeted fiscal support can help mitigate those, and multilateral cooperation and national policy coordination to manage these spillovers. That's I'll stop there.
Okay, thanks. Thank you very much for your very comprehensive presentation. There is also an angles of how the between emerging markets are affecting global and other economic growth and the volatility of the growth at the same time. So, in interest of time, perhaps we can move on to Neil question. And Neil, I don't know any. Yes, more than one than
No, thank you. Thank you, Nicholas, for the presentation. It was very useful. I think in the interest of time, I'll just focus on maybe my main comments rather than talking about the nice things I was going to say about the chapter. Looking for an opportunity to talk about. I think it's an important contribution. I think it links to this broader literature looking at how shocks percolate across economies, whether they're financial shocks, whether they're shocks due to climate related weather events, whether it's bottlenecks due to pandemics. So it fits into this big literature around the role of shocks. I think it adds nicely to that literature. And there are a number of key messages now: the increasing importance of G20 economies, the global economic production, the increasing importance of trade. Obviously, this headline, the spillovers have increased. And I think importantly, this sort of angle of looking at identifying heterogeneous effects across sectors is crucial, because that has important policy implications in terms of providing support for those sectors, for example. So I think there's a lot of positive aspects. But I'll focus on the sort of bigger comments and questions that I have. And the first one has really been addressed to a extent, and I mentioned it anyway. And that's this question about how important should we worry about these spillovers? Because I mean, this is a fairly big shock we pose. 2.5% decline in TFP, which is a 10% decline in output in emerging markets. And that reduces global GDP by 0.15%. It doesn't seem like something we should get too concerned about. Now you've said it's a comparison of long-run steady states and so on, but it just sort of raises questions about to what extent we should be worried about this. And in that last example, for example, the vast majority of the 0.5% decline was due to the direct effects of the emerging markets rather than spillovers. So there's just an initial question really, and you partly answered it. A bigger question is around what drives these results and spillover effects, because from the chapter I can see two major drivers. On the one hand, we've seen that G20 emerging markets now account for a much larger share of output. So there's a scale effect, so to speak. So it could just be that these spillovers are driven by the fact that a 10% drop in output in emerging markets represents a huge drop in global demand and so on. And it could just be due to scale. The second effect would be due to trade integration. We also see that trade integration has increased. It's probably also the case that positioning of these countries in trade networks has changed to make it more central. And this could also be driving those spillovers. It's not clear from the model which is the major driver. That's more a technical exercise, but I think it also has implications for policy response. Maybe that should we impose the same policy responses if these spillovers are being driven by scale effects versus change in trade structure and so on? That was just good question came up. Turning to the policy conclusions. Yeah. One conclusion that Straw was that given, well, the countries, other countries maybe need to provide buffers, reduce current account deficits and so on to minimize external vulnerabilities and so on. Then again, I can see a couple of responses to that. Is that these policy responses all have costs, some costs in imposing these policy responses. So one response may be, well, given that these shocks, maybe the spillover effect of these shocks not large, and actually given another result that you found is you didn't talk about so much is that actually volatility in the economies has declined, so perhaps the risk of these shocks is also diminished. Should we be really focusing on policy responses? That's one response. Yeah. Maybe another extreme would be to say that fairness is key. We need to respond to these policy shocks, but how to do that in a world of radical uncertainty? So, what will the next shock be? Will it be a positive or negative shock in emerging markets? Will it affect the general economy? Will it affect specific sectors? I think these are also crucial pieces of information in order to draw these policy conclusions. So there was a sort of, maybe in my mind, a bit of a disjoint between the results and the conclusions. And two more comments. So the ultimate comment is, why G20 emerging markets? Why focus on that as a group? I mean, you highlight there are many commonalities. They're all emerging. They're all G20. They're also becoming more important globally. And that's also something you highlight. But there are also lots of differences in the economies. They straddle 4 or 5 different continents. They include economies that are heavily invested in manufacturing versus economies that are primarily involved in extracting resources. They include highly diversified economies and Saudi Arabia, which is basically a monoproduct economy. So they're also very different in many ways. And given their different geographical locations, as you also highlight in the results, they serve different markets to a certain extent. So I guess the basic question is why the G20 emerging markets? And maybe the more deeper question is, what are the things we should be looking at if we're looking to identify spillovers in terms of the commonalities and economies that should guide us in thinking about? And then my final comment is something of a throwaway remark. On the one hand, it's a very detailed, minor detail. It's about language. On the other hand, it's quite deep. So the chapter talks about is going to model the effect of shocks, the spillover effect of shocks. And then at other points in the chapter, it talks about upturns and downturns. So the question is, what is a shock? Is a downturn a shock? Oh, and I think so. In a simple sense, it's a very sort of detailed question, linguistic thing about what is it talking about. But on the other hand, it's actually quite deep. I mean, well, maybe a stupid analogy, but in terms of human behavior, if I'm shocked, I react. If I'm mildly surprised, I'll react. But I'll react differently, not necessarily in a linear way. No? So I'm sure in a global economy, it's also the case that you have these non-linearities, feedback effects, tipping points, and so on. And it raises the question of whether the model, and I understand there are constraints to the model, can account for differences between shocks versus mild upturn downsides. Exactly. And whether the policy implications would be quite different. So again, that's just quickly going through some of the bigger comments I had. The overall chapters what I use. Thanks. A few minutes for the people.
Thank you all. Thanks very much. So perhaps I can give the floor to me. I don't think you need to respond all the company, but you can select a few major things. It's fine.
Sure. So no, thank you, and all your points are well taken. And certainly thinking of a lot of these questions. Just to kind of mention on your first point, in terms of small results. So, like as I mentioned with the quantitative trade model, there's a few reasons why those effects might be smaller. we can kind of compare to the impact of the United States, which is smaller and so on, but this kind of connects a little bit to the what is a shock question. We do a little bit of robust analysis. We play around with kind of the calibration model. We can do more short-term flavoring, and it creates much larger aggregate impacts. But in terms of like nonlinearities and so on, those are certainly important and worth thinking about how we might, even empirically look at different types of scenarios. Point taken about how policy inclusion depends on cost versus benefit analysis, and I think that would be kind of like an important place to go next to try to really refine and try to understand, to what really are the welfare implications of sort of not having these types of buffers in place and so on. So thank you, and look forward to questions.
Sure. I also agree with you. We would know on one point that how much this kind of impact is coming from the sheer scale effect. Because there's one question about how much emerging G20 and Asian emerging markets account for the. So if the majority of the spillover effects are based on the side effect, and then to what extent some structural factors are affecting spillover very efficiently. If there is any way to decompose the scale and the structure component, that would be very helpful in coming up with the relevant policy. Great. So let me open the floor for any questions from the audience inside the room, and so those who are maybe virtually. Any question that had? Is this Henry? What?
I think that's way a while ago. It's big.
Because this is by the time period is going to. Henry, would you like to clarify your question in the chat box? Or?
Still there.
Okay, so any other questions? Yeah, sure.
Can you show you had at the beginning a slide where you differentiated into domestic and international? I think it was the growth coming from shocks international.
In the slide you're referring to.
I was just wondering there. Yes, I mean this is interesting. That you ended in 2019. And I mean the major shocks happened basically afterwards. I mean, if you think about it, we had so I mean, I don't know how this influence, but something which is integrated.
No, I mean, this is a valid point. Of course, right after this standalone happens, COVID and the kind of global shock. But I think the point you wanted to make here is sort of the history of the last 20 years without necessarily getting into the post-COVID period, but
right, the FDI effects on G20 after 2020 or 2020 onwards have been particularly big.
You're referring to this FDI.
I mean, this was not related to you, just to say what and only FDI this one. That FDI G20 very, very bleeding of 2020. that say, good to interpret it, because then you can really see.
Thank you.
I have a second.
Yeah.
And honestly, it's always interesting to see such a model. Think about it, and a lot of rethinking comes up in years. It's interesting is actually to see what. Because in the other countries, their ability to react. So if we see the spillover effects, impacts them negatively, but as well you have it in a what is interesting. It's a kind of agility, is a kind of very shifting patterns gives this maybe interesting to see. So yet to react, but we need to benefit from.
Yeah, no, this is a good point, you know, to really kind of dive in and understand what are the characteristics of economies that are most resilient to shocks. I mean, for that, one would, you know, kind of want to, one would need to control for different trade linkages in the first place, right? So when we look at the country specific impacts, we're kind of combining all of that into one, and when we look at the impact, essentially in the trade model estimation, like for example here, and we get these results, right? If we kind of calibrate it with a more short-term calibration, so lower elasticities of substitution, the aggregate sort of declining output is larger. And sort of the implication is that because you can't sort of reallocate efficiently or as effectively, that you can sort of make up for the lost inputs or change your structure of production. So one, and then in fact, it's indeed, like, calibrating it with a more short-term calibration leads to sort of, for example, this is for what would imply kind of, let's say, at least 4 times larger aggregate impacts, and country level sort of impacts. And so that's why one of our policy messages is to have policies in place that sort of facilitate and don't interfere with reallocation so that resources can be reallocated. But of course, because of this kind of winner and loser element, and in particular changes in jobs across sectors, so fiscal support for those is important, so that ensure that benefits everyone, the economy.
Can also imagine how much challenging that is for dynamic police to come up with concrete policy recommendation after going through this rigorous analysis. Then fiscal policy, also the cooperation, generic forms of, but yeah, the growing way, emerging wage, or something, both in the ability that much. We consider giving more IMF to these countries outside than just joking. Anyway, so this has given us very important and very useful food for thought, and we would also take from there for our future research, and then also in particular for the Asia Pacific context. So this has been useful, very meaningful research. Well, so with that, I'd like to thank the class for your very insightful and interesting presentation. With us. With that, I also have one housekeeping announcement. We have another next round of the RSI webinar series to be held on the May 7th, Tuesday at the 9:10 a.m. Manila time. It's gonna be done purely virtually, and the speakers will be, the topic will be the cross-border carbon market linkages, implication for the Asia and the Pacific. We will be inviting 2 speakers. First one is Michael Melling from the MIT, and the second person will be Jackson Owen from Duke University will be listening to their insights about the pros and cons of cross-border carbon market linkage. So look forward to seeing you again. It's round 7. With that, thank you very much for joining us, and class for coming to us. Thank you very much. Thank you.